This is Bryan Rich from Money Markets TV. Mark Twain once said, if you don't read the newspaper, you're uninformed. If you do read the newspaper, you're misinformed. That couldn't be truer in this era of crisis. If you read the daily newspapers, you likely think the Fed and US government are making critical mistakes that are hindering our economic growth and destroying the dollar in the process. I see it differently. I think policymakers have done such a good job at restoring confidence that people actually think there's a real recovery underway. So they're raising the pressure on governments and central banks to move away from the emergency policies that prevented an all-out global economic disaster. But there's a disconnect between facts and perception when it comes to the state of the world economy. The global financial system, which underpins all economic activity, is still mired in bad debt. The unprecedented coordinated intervention stabilized the system, but the recovery it produced is entirely manufactured. Underneath the numbers of government spreadsheets, most major economies in the world look like and feel like depression. Nowhere is this clearer than in Europe. First Greece, then Ireland, now Portugal, and possibly Spain are on the edge of default on their sovereign debt. But European officials keep delaying the defaults with bailouts, hoping to bridge the gap between an economic downturn and a sharp, sustainable recovery. But even the optimistic official outlooks now agree that a recovery like that just isn't in the cards. And meanwhile, the dominoes keep falling, and the resources to keep propping them up are dwindling. One thing we haven't seen yet is a total collapse of the euro, despite the fact that the shared currency is the core of the sovereign debt problems in Europe. It's the monetary union of the Eurozone nations that keeps these bankrupt countries from righting their own ships. That's because these nations can't cure their insolvency by currency devaluation, and they aren't free to restructure their debt. So why has the euro remained on solid footing? Well, the euro is the second most widely held currency in the world, and global partners like China have a vested interest in helping Europe buy time by keeping the currency stable and relatively strong. But recent history offers evidence that global support could be coming to an end. Exhibit number one is the European Central Bank's new tighter monetary policy amidst a worsening economic crisis. The ECB hiked rates in 2008 during the global financial crisis. That move triggered a 22% decline in the euro. When Greece formally asked for aid a year ago, the euro fell 13% until China came in to stabilize the currency. And a similar fallout happened after Ireland asked for help late last year. This time, the decline could be even worse because Portugal's request for aid coincided with an interest rate hike by the ECB. And if the euro does have another sharp down leg, I'm not sure this time that China and the international community will still be there to support it. We don't know how the situation will play out, but it looks very much like a game of musical chairs. When the music stops and the fallout in Europe confirms the next major wave of global economic crisis, expect the world's focus to turn away from concerns about inflation and again back to concerns about growth. So the time to look for a chair is now, before the music stops. I'm Bryan Rich from Money Markets TV. Thanks for watching.